Hey everyone, in today's video, I'm going to be going through my $92,000 tax-free savings account, or TFSA as we call it. This should be a really interesting video. I'm going to go through each of my positions, what percent of my portfolio each of these are, the gain or loss I've had in each of these stocks. So stay tuned till the end of this one. In the description, I will post a video I recently did on all of these stocks that are in my TFSA, going into a bit more detail on the companies themselves. This video will be a bit more about the portfolio, what I'm up, what I'm down on, and my thoughts overall on each of the companies as well. So if you like this type of content, be sure to give this video a big thumbs up. It really does help with the YouTube algorithm. And if we get the 40 likes on this video, I will post how many dollars in dividends I've actually got in my TFSA every single year over the last 10 years. So that should also be an interesting video. Just a bit of incentive to hit the thumbs up button for me. I really appreciate it. Okay, so getting into this video, first of all, just before going into the stocks, I have $92,000 in my TFSA, as you can see. I believe my cap on my TFSA in terms of how much money I've put in, somewhere between $60,000 to $70,000, maybe around $65,000. So I'm up pretty well in this account, about $25,000 to $35,000, depending on exactly how much my max contribution has been. In the last 3 years specifically, you can see here I'm up about 29%, so annualized about 8.7%. The purple line that's dotted here is my overall gain since the summer of 2020 to now, and then you can see some comparables. S&P 500 is up closer to 40%, but I don't really compare against that just because the majority of my stocks are Canadian stocks. If I look at the TSX Composite, it is up 33%, just under the S&P there. So that's probably a better comparable for me given the type of stocks that I'm investing in within my TFSA. So I'm lagging at a couple points, but overall pretty in line overall. I was actually right in line with it a few months ago, over it for a while, but some of the companies I own in this portfolio are REITs and some other dividend stocks that are in industries that have been hit a bit harder than others. So without further ado, I will jump right into the portfolio. The first stock you see on the screen here is RioCan REIT. I have about $9,000, give or take, of market value, down about 20% in this account. And as you can see in the top corner, it's about 9.5%. So almost 10% of my TFSA is in RioCan. RioCan's a stock that I've owned for years and years. That's why my cost basis is so high on it, because it's really crashed here lately, but most of these shares have been bought in 2018, 2019, 2017, before the crash of real estate during the pandemic, in terms of the REITs at least. But this is a stock that I really like. They're going to do about $1.80 of funds from operations, so trading at just under 11 times earnings here. Get a nice monthly dividend yield. I really like their assets, their exposure, where they are. And retail space in Canada, for those of you who don't know, is much less on a retail square feet per customer or per capita than it is in the US. So I do think there's more of a runway for retail growth in Canada in terms of dollar per square feet. And RioCan has most of their portfolio in big cities like Toronto, like BC, these growth centers for the country. So that's a stock that, even though I'm down on it, I do plan on keeping it. I do like the dividends I get every month from RioCan. The second stock I own here, and just so you know, I'm organizing these stocks from down the most on a percentage basis to up the most on a percentage basis. So you'll see a lot of red in the first half of this video as a fair warning. But the second stock I own here is First Capital REIT. Very similar company to RioCan, very similar hypothesis on this company and reason I hold it. I think they have great assets in a great country, great economy for real estate, and think long term they'll do just fine. This one's been hit down a lot over the pandemic, down 16% overall. Have a very similar size position in this one as RioCan, and this one's also paying me about a 5 to 6% dividend. Going into my third stock here, Bank of Nova Scotia, also known as Scotiabank. So this one's down about 15% here. This stock is going to do about $7 of earnings per share this year. So trading under 10 times, paying me a 6.5% dividend yield. The Canadian banks have done really well over the long term. And they kind of operate in this oligopoly in the country where if anything really bad was to happen, I can't imagine the banks getting wiped out or the equity of the banks getting wiped out. I think the government would help them. I also think there are so many laws and regulations in place that restrict them from getting themselves into too much trouble in terms of capital ratios and things like that. So I think generally the banks will continue to be super profitable. I'm getting that 6.5% dividend from Scotiabank. It's tax-free in this account. So I really like this position. If anything, Scotiabank's one that I may look at adding more of in my TFSA as I get dividends across these stocks to reinvest in these companies. Fourth stock, not surprising, another REIT, and it looks like it's going top to bottom from absolute amounts because Allied is down 38%. This stock was a darling of the street when I first got into it, and when I was averaging into it, I was actually way up on this one, about a $33 cost basis. The stock went up to $50, was feeling really good on this one, up like 50%. But at the end of the day, Allied primarily owns office properties. And despite the quality and how they're all Tier A in downtown cities, office real estate has just gotten hammered, both from an occupancy level, but to a greater extent, the valuations and the REITs, because there is some concern on whether they're going to be able to get refinanced when the mortgages come due, what the longer term trajectory of occupancy rates are, and so on and so forth. So this is one that's going to do about $2.20 in funds from operations this year. So trading at about 9 times earnings. So really low valuation relative to their historical performance, but there's a lot of reasons behind that. Overall, and I've talked about this before, so I'll keep it quick, but while this one's definitely more of a volatile one, a bit more risky, I do believe that trading at a 9 times funds from operation, paying an 8% dividend yield, the risk reward on this company is favorable in my opinion. It could keep going down, but I think there's more likelihood this one bounces up to 12, 13 times funds from operation, which would be closer to $30, which is 50% upside, getting paid over an 8% dividend, just a wait here. So this is one that is a bit more risky, but I'm definitely not selling at these all-time lows in the stock. ZWB, so this is a relatively recent position. I think it's about a year old, but this is just a covered call ETF paying an enhanced distribution yield on the Canadian banks and the premiums that they get from writing the covered call ETF. So I'm getting about 7-8%, probably about 8% dividend yield on this one. I like having it in my TFSA so I don't have to pay dividends on those distributions. But as you can see, with the broader banking sector this year, my overall return has been low, down 13% on the stock, probably got about 8% back on dividends. So net probably still down on ZWB here. Next stock, and you can kind of get a read here of how many REITs I own in my TFSA. As some background, when I first started investing, I was all in REITs the first year for the most part, which I can show you in that dividend breakdown year over year over year if we get this video to 40 likes, and a nice plug there. But Northwest is one that I'm lucky that I actually have a relatively low cost basis. This stock was up at $12, $13 just a year ago, so down about 50% from that. But I got into this one years and years ago in my TFSA, I believe. So my cost basis is only $8, only down about 14%. Currently, this one's paying about a 12% dividend yield, but they're definitely considering what the future of their capital allocation strategy is. So I don't know if it's sustainable for them to keep paying out that same dividend yield, given where the stock price has gone, given some of the issues they've had with their management fees of hospitals and whatnot. So sitting on the sidelines on this one, interested to see how it all pans out, but I am just reinvesting all the dividends I get from Northwest in other opportunities in my TFSA. The next stock I own in my TFSA is Fortis. So Fortis is a regulated utility company, pays a really stable dividend yield, just over 4%, I believe. So pretty safe play, just getting that 4 or 5%, getting some slight dividend growth year over year over year. So a steady one, but one that I think if I hold on to it for 10, 20 years, I'm going to be pretty happy with the compounded return that I get from it. The next stock I have in my TFSA is Rogers Communication. So Rogers Communication just acquired Shaw Communications as well out west to build a really national network and national presence, especially on cable and some of the other areas that Shaw was really strong in. Currently down about 3.5% on this one, getting close to the stocks that I'm up on here. So excited for those. But yeah, these ones like Fortis, Rogers, they're more recent builds in the portfolio, and because of that, I don't really mind if they're up or down a couple percent. They're all paying me dividends every quarter anyway, and that's really what I'm prioritizing. Next is A&W Royalty. So this is one that I've bought pretty recently too. I did another video on how I actually sold Google in my TFSA. It was the only U.S. company I owned in my TFSA, but I sold Google for like a 200% gain. I think overall that sale raised over $10,000 in my TFSA, and A&W is one of the companies that I decided to add to my TFSA to get some dividends from A&W in this account that were tax-free instead of having Google, which I wasn't really benefiting from on a monthly basis from a tax perspective. Just was able to cash in on that huge capital gain tax-free, which was nice as well. But A&W, I really do like the royalty model just because it comes right off the top line. You don't have to worry about inflationary pressures on food costs, on labor costs, on rent costs. If anything, inflation that moves menu prices up, as long as units and the amount of food they're pumping out remains the same, it can be beneficial for royalty companies. So I like having these royalty companies provide really solid and stable cash flow for me. Okay, and then the first stock here that's in the green. Nice to get to this point of the video, but it is Pizza Royalty Corp. Pizza have about a $5,000 position, about 5% of the portfolio. So you can see some of these ones up here, like Allied. Well, I'm down 38%. It's only 2% of the portfolio. Used to be a bit more, but only about 2% of the portfolio. Northwest only about 2%. The rest of them about 4 or 5% here. The first three were pretty big positions. Now we're getting into some big positions on the gains as well. Pizza about 5.5% here, up 12% on the position. This one's also been paying me really nice monthly dividends. Same sentiment around Pizza as I have on A&W Royalty in terms of why I like royalty funds. So this one's been serving me pretty well, paying me about 6% dividend yield, and on top of that, actually got some capital appreciation as well. Next stock here is Restaurant Brands International, ticker QSR. This company owns Tim Hortons, Burger King, Popeyes, Firehouse Subs. Pretty small position here, only about 3.5%, but I am up over 20% on it. So that's good to see. The other thing to note is every single stock in this account pays me a dividend, either monthly or quarterly. So whether the stock's going up or down, I am still getting cash flows and being able to reinvest those dollars across these stocks on whatever is looking weak and attractive to me at any given point of time. The second largest stock I have in my TFSA is TD Bank. So I have 140 shares of TD here, up about 16%. Looks like I have about $10,000 I invested in, currently at $11,500. So nice to see that I have a pretty big gain here in TD, but I really do like holding on to this one, getting that dividend every quarter. I've talked about it before in other videos if you're interested in going in and looking at a deeper dive, but TD is one of those stocks that I really do want to hold for the long term. They're trading at a relatively cheap multiple, in my opinion, just around 10 times earnings for one of the biggest banks in North America. They only operate in Canada and the US, which are very strong economic markets, and they have great loan books. They are primarily a retail and commercial bank, which is a lot less volatile on earnings versus like RBC or Goldman Sachs or these banks with heavy capital markets exposure. So because of that, I think they're a bit less cyclical than the broader banking sector. Like that element to them. Think they're really good at allocating capital, increase the dividend every year, buying back shares when they have excess capital, and really looking at smart expansion opportunities as well. So TD is one of my biggest holdings across accounts, and that remains true in my TFSA. And my biggest position in my TFSA that is also up the most now that I've sold Google is Canadian National Railway, up 35% or $6,000. So I have about a quarter of my entire TFSA in this one position, about $23,000 of current market value on CN Rail. CN Rail is just probably my favorite company I hold in my portfolio. Has such a strong moat. It's so hard to compete with this company. It's so many regions that they serve that it just does not make any economical sense to use any other mode of transportation to transport goods in or out other than CN Rail. And in addition to that, it's so many regions that literally physically cannot move their product any other way outside of their town other than on CN Rail tracks. So they have a great moat. No one's building new tracks. They go coast to coast in Canada. They go down into the US as well. In addition to that, they're investing heavily on expanding their ports on the sides of the countries to have a bigger freight business in from international and exportation. So lots going on this business from the transportation logistics side of moving goods across the economy. And they're also situated, obviously, in one of the world's strongest economies across North America. So really good top tier railroad in one of the best economies in the world for the last couple decades, but also going forward. And it's an asset class that just cannot be replicated. They've increased their dividend every single year since they went public in the 90s. It used to be a crown corporation owned by the government, but they put it public. And it's just provided financial fantastic results ever since. So one that is currently trading at about 20 times earnings. They're having a bit of a slowdown year just because last year was so explosive. But long term, they've really shown the ability to compound their business and their returns. And that's why I have such a big bet on it within my tax-free savings account here, about a quarter of everything. So this is my overall portfolio here. Just taking a quick look at it before going to the next slide. You can see how very invested in REITs here. So if I was just to add it up, it's about 20%, 22, 23. So about a quarter of my portfolio is just in REITs alone. Between banks, I have Scotiabank here at 10 and then TD at 10, so or 12. So close to 25% on banks, 25% on CN Rail, and then about 25% across other asset classes, whether that's restaurants or just the covered call ETF that I have here as well, which I guess you can flood into the bank. So pretty well split four ways between the rail, real estate, banking, and then food. And that's just how my TFSA is currently situated, trying to position it to obviously maximize the value of having this TFSA or tax-free account by making sure that I have high-paying dividend stocks, lots of them with ineligible dividends flowing into this account where I'd otherwise have to be paying a pretty hefty tax bill on an annual basis. So once again, bottom chart here is just my annualized returns over the last 3 years, clocking in at about 9%. At the top, you can see my unrealized gains in this account is about $1,200, give or take, or about 2%. This was a lot higher before I sold Google for about a $7,000 gain. But it's interesting because when you look at this page here, you see a lot of red. But overall, if you were to add up all these numbers, even with what I haven't sold for gains and what I've just been holding, it is a net positive unrealized position by about 2% of the portfolio. And in addition to that, these companies have all been spinning off dividends on a quarterly or monthly basis. And that's really not accounted for in this $1,200 number. Like I said off the bat, I think I've invested about $60,000 to $65,000 in this account. So I'm up about $30,000 in absolute value. Just the majority of that has already been realized from selling stocks that were up significantly big, like Google as an example, or just through the dividends I've been getting over the last number of years, which I'd be happy to show you on another video in the next week as well. So overall, that is my TFSA portfolio. Let me know what you think of my TFSA or any of these stocks in the comments. If you like this kind of content, be sure to give this video a big thumbs up. Let's get to 40 likes. I'd really appreciate that. And I will see you guys in the next one. Thanks so much.